Let's start with tariff developments. How have they shaped rates markets in 2025 so far?
Sam, thanks. I think there's two distinct ways that tariffs have impacted the bond market in 2025. The first is through this narrative about U.S. exceptionalism. It's also meant that policy rates have been buoyed at higher levels in the U.S. than elsewhere. But really importantly, given the strong participation of foreign investors in U.S. financial markets, and in particular in the U.S. bond market, trade negotiations against the backdrop of still wide budget deficits is having investors question what the prospects for foreign demand in the U.S. Treasury market look like now and over the medium term. The second way that this has impacted the bond market in the year to date has been through investor positioning. As we entered 2025, there was this distinct softening in the sentiment data that led investors to think the risks of recession were increasing. As a result of that, investors positioned for lower yields, expecting that this would lead for the Fed to step in and lower rates to counteract that. However, with the tariff announcement that was made in April, we went from thinking we were in a possibly recessionary environment to thinking we're in a bit of a more of a stagflationary environment. We saw investors unwind those long duration positions as they began to balance weaker growth with higher inflation. Combined, the weakening U.S. exceptionalism narrative and the question over demand for U.S. assets, alongside this positioning dynamic, has been something that's helped elevate long-term interest rates and helped twist steepen the yield curve in the year to date.